Good morning and welcome to our Value Disruption Strategies in the Pandemic webinar. Sorry about getting a late start there. We had some technical issues, which nowadays is just something that happens all the time. So today we have two individuals from ABIP PC and CPAs. And I think you guys need a couple more letters in there just to make it fun. Maybe throw an XYZ or something in there. And so they're gonna do the presentation. I would like to thank our sponsors for today, Andrews Myers and Cherokee Piping Company and Fire Protection. Sorry, I've got some weird stuff going on here with my computer. All right, so you guys should be seeing the webcams here in just a minute or two. Both Michael and Lindsay are on. So Michael Landers, CPA, is a partner at ABIP PC with 20 years of experience. He has a strong focus on delivering unmatched client service and leading social and technical business development activities. Michael is a proactive, results-oriented professional with an effective team-building approach and a hands-on work style. He has the proven ability to innovate, analyze, organize, lead, and manage others, problem solve, and communicate. Michael has extensive experience in many areas, including financial and operational reporting and analysis, SEC reporting, GAAP compliance, internal controls, strategic financial planning, and M&A. He was the lead on external audit and review engagements for publicly traded and privately held companies with revenues ranging from $6 million to $1 billion. In the past, Michael provided due diligence reviews in corporate transactions and applied his industry knowledge and understanding of business drivers to perform evaluation and financial analysis of operational performance. Lindsay Duke is the senior manager at ABIP PC and brings over 16 years of professional experience to the firm. Lindsay works with the specialty tax consulting practice, where she focuses on assisting clients identify and optimize potential tax credits, deductions, and incentives that are available at the federal and state levels. She has extensive experience in a number of areas, including R&D and orphan drug tax credits, energy credits, IRC 199-263A, and accounting methods and tax dispute resolution. Lindsay has previously worked with Big Four accounting firms and specialty tax consulting. During her career, Lindsay has assisted clients in a variety of industries, including oil and gas, architecture and engineering, life sciences, software, financial services, and manufacturing. Lindsay has spoken at conferences on topics such as federal tax topics in turbulent economy and international, federal, and state tax updates. And with that, I will turn it over to the two of you.
Great, thank you, Brana. We'll go ahead and get started. Do you want to go ahead and just move to the next slide, and we'll jump right in. So first of all, thank you everyone for taking the time to join us this morning. We hope you enjoy the presentation. Michael, do you want to go into a little bit about the firm before we get started, or?
Yeah, so our firm focuses on providing full service, pretty much anything you can think of from an accounting standpoint, but to firms that are anywhere ranging between 10 million and 100 million in revenue. So that's really where our size is, but all private. We don't really focus on the public space at all. So that's just a really high level overview, but we're a full services firm. Thank you.
Great. Okay. Let's move on to the next slide. And as we're talking about rebuilding value in a turbulent economy related to the pandemic, I'll start with a statement of the obvious in that there's been quite a bit of economic disruption this year. I think everyone has pretty much experienced that to some degree. And depending on the industry you're in, it's had either an impact where you've decided to morph your business into different approaches to how you get work done. If you're in essential services, perhaps you've been able to maintain your business operations as normal with a few tweaks, but you're seeing that maybe your clients are struggling a little bit or evolving themselves, and so you're adapting as they're adapting. I think some of the industries we've seen have been impacted the most significantly are restaurants, airlines, obviously, oil and gas, hotels, and the automotive industry. And they make up about 30% of the workforce in the United States. So to the extent you have customers in these areas, you want to be aware of some of the challenges they're facing, how they might be evolving their business, and then also how you might be adapting and changing based on meeting your clients' needs. Okay, I think we'll move to the next slide. Another area that we've identified and we understand there's been some significant impact are in missed payments. For example, 26% of Americans have taken advantage of a payment deferral plan, and that's as of September 15th. With continuing lockdowns and a new round of lockdowns that are anticipated as the virus is increasing in infection rate right now, we might expect that that number might climb. Additionally, 6 million Americans have missed their September mortgage or rent payment. Right now, there's federal programs to assist with those rent obligations, and many banks have actually taken the approach to help assist their clients in the event they need to delay or may miss a mortgage payment. In addition, 26 million students have missed student debt payments. I know there's some confusion here in that, well, didn't Congress say we're delaying student loan payments until the end of the year? And yes, that's very true, but that only applies to government-held student loans. There's a large body of student loans that are not owned by the federal government that safe harbor does not apply to. And what we're seeing is that as those missed payments are increasing, even the servicers who own those loans are trying to do what they can to be flexible as far as offering forbearance related to COVID-19 or pandemic hardships to help those students who are currently missing payments. It's just that the benefits aren't as great because there is still interest that's being capitalized when they're delaying the payments. Whereas under the federal program, there's no payment and no additional interest due. Okay. And in addition, roughly a third of adults believe that eviction or foreclosure is likely within the next 2 months. That's huge, and especially as we're talking about potentially more lockdowns or increase in the restrictions on businesses operating, the potential to bring in income, we might expect that that number has increased since we identified that figure in September. Okay, do we want to move to the next slide? Another related area that we've seen increased activity is in pandemic-related fraud. Unfortunately, given the shift in the workforce from going into an office where there's procedures and protocols in place to a more virtual workforce, it's increased the opportunity, unfortunately, for so-called bad actors to have the opportunity to steal information, break into systems. We've actually seen, as of August, a 77% increase in fraud and a 41% increase in unemployment fraud. And that total increase is projected to be 92% over 12 months since the beginning of the pandemic. One of the things that businesses can do to mitigate some of the potential risk here is take a look at your internal controls. Identify if there are ways to increase security or put procedures in place to protect your business information, financial information, and also information of employees who are working for you to make sure that they're following best practices to protect the business and prevent fraud. Okay. Go ahead and you can move to the next one. Okay. And then PPP loan impact. I know this is a topic on many businesses' minds, and that's because as of the end of the SBA PPP loan program, the first round, there are over 5 million loans that were issued. The average loan size was roughly $100,000, and over 98% of the loans issued were $1 million or less. So there's a large number of businesses that have taken advantage of the program and are now working through a confusing loan forgiveness process and also trying to understand the tax impact around the loans that they received. I think when the PPP program was first rolled out, there was an initial consideration that there might be a tax impact, but the initial thought process was this would be essentially a grant meant to help businesses, and there might not be any tax impact that would have to be considered. This last November, Treasury and IRS have actually issued clarifying guidance about the tax impact of a PPP loan. And to the extent the loan is forgiven, it's not included in taxable income. However, those expenses that are paid with a loan that is forgiven, treated as a cancellation of debt, and those expenses are no longer deductible. So you'd essentially think it would be a wash. However, if you consider that many businesses who took this loan did so because they needed funding to keep their business afloat, the fact that they're now going to have a larger tax impact due to the inability to deduct the expenses that were paid with those funds presents quite a challenge. And the IRS guidance has recently said that if there's a reasonable belief that the loan funds will be forgiven, the expenses are non-deductible. If it turns out that part of the loan is not forgiven, then you are able to deduct that portion of the expenses that were paid with those loan proceeds. So the only thing that would change that analysis would be if Congress were to pass some legislation that basically undoes what the position has been taken by Treasury and the IRS at this point. So it doesn't mean you shouldn't apply for forgiveness, obviously. You would still have that loan completely forgiven under some circumstances, but it's time to kind of start considering the tax impacts and understanding that tax liability, and also think of ways to potentially mitigate that tax bill. And there's a few opportunities we have in mind that may be relevant to various businesses. I've listed a couple of them. The first are NOL carrybacks. The CARES legislation has introduced the ability to carry back a loss occurring in certain tax years back 5 years. Previously, that opportunity was not available. So it allows businesses who are in a loss position, not necessarily paying tax, to go back and create cash, generate cash by carrying back that loss and recovering a refund of tax paid in prior years. And again, that ability is to carry back a net operating loss up to 5 years. It can also be carried forward. Another area to consider are tax credits. One of the ones I've listed here is the R&D tax credit. This is one that's an extremely powerful credit simply because the extent of R&D conducted by companies, especially right now, has been increasing. And while the expenses incurred that are paid by loan funds aren't deductible, and that small percentage would not be able to be included in the credit, if you consider that many businesses aren't currently claiming a credit, there's an opportunity to offset your tax liability not only in the current year, but up to 3 years prior. So the way the R&D tax credit works is it's available for the open tax year. So if we talk about 2020, and then the prior 3 years, you're able to go back and amend the return to claim a credit for research and development activities and expenses incurred in prior years as well. And depending on whether or not that NOL is something you're able to take advantage of, you could be able to go back even further. So for example, if you go back 5 years to apply an NOL, there's no tax liability. You wouldn't necessarily be able to use a credit for that year, but because you're able to carry a credit forward for up to 20 years, say you in a year where you have a loss, you generate a credit of $20,000. You would carry that credit forward for the entire time or up to 20 years until you're able to use that credit. So for example, in 2020, when you have an increased tax liability potentially due to a PPP loan fund, that would be an opportunity. One that I didn't list on this form are the paid tax leave credits. These are unique to this tax year currently. There is legislation proposed to extend this benefit, but right now for employers who are offering or who have employees who have to take time off due to COVID-related reasons, for example, they are experiencing symptoms and are self-quarantining, or are providing care for a child or family member, or have their daycare closed and are unable to work because they need to provide care to their child because their normal service provider is not available. There are specific tax credits that are available and these apply to payroll tax. So while the R&D tax credit would offset federal income tax, the paid leave tax credits would offset the payroll tax paid related to those activities or those payments to individuals who need to take time off due to COVID-related reasons. So there are some benefits there. There is new legislation that's proposed. I know several of these incentives are scheduled to run out at the end of the year. And there's been some concern that the first round of PPP loan funds have been used. Businesses are still struggling. So what's the next step? And there's current legislation that's being proposed. There's kind of a back and forth right now, but it does include PPP, an extended PPP program on a smaller scale to certain businesses. It would operate in a similar manner. It would also allow an extension of those paid leave tax credits that were set to expire at the end of the year. There's an offer on the table to extend those, I believe, through April. So those benefits may continue to be available just depending on when that legislation is passed. So, and Michael, I think I'll let you take over from here.
Great, thanks, Lindsay. I appreciate that. So next slide is, and I apologize, it looks like we should have an extra slide just for my office here that looks like the pandemic has hit really hard. But no, the next slide here covers bankers' concerns. You know, over the past few months, there's been several issues that have come up, primarily PPP funding, but also normal business. So, you know, it relates to bankers and what their outlooks have been. They've been fairly easy to work with and flexible, not only on covenants, but on how to react to change in cash flows, how to respond to the PPP impact on your ratios and other things that could limit your ability to borrow and draw down on that debt to the extent that you need to. One of the new things that we've seen is a requirement for, to the extent that you might have a personal guarantee or have some sort of issue where the bank needs a personal guarantee. We've seen a lot of requests for personal financial statements. So just having your personal affairs in order as a business leader is probably something that you should just be prepared for as you enter a conversation with the banker and might need either some additional working capital or at least need to restructure some of your financing. So something to think about. But, you know, bankers are, cautiously concerned with ability to make payments. Are you going to be able to draw on it? Again, that's where a personal guarantee might come in. And then, are you really in default, or should there be some sort of mechanism to keep you and the bank from having to go through a default scenario? And all of those things, as long as you pick up the phone and reach out to your banker, you should be able to get through and troubleshoot. So, definitely try to be ahead of it and be not necessarily in their face, but be on top of the issues and what they are. That way you can see what the resolution may be. Banks have not been, or at least so far that we've seen, there hasn't been a lot of hard stance on calling debt and causing them to do fire sales, even in really troubled business areas where there is a fair likelihood that there will not be a return of cash flows to the business. Banks are not set up to take and collateralized assets and sell them. That's not their primary. In fact, they don't like to do that. They can't get the return that they could get in a market environment. So we haven't seen a lot of that. That doesn't mean it's not going to come down the pike, but up to today, it hasn't been a reaction that we've seen. And then I guess primarily it's just restructuring those deals. We also have not seen a lot of ask on additional fees to restructure debt covenants. So normally, if you're facing an issue or a cash crunch, a bank might say, "Oh, well, you need to pay us an origination fee in order to get that debt." We haven't seen a lot of that. So they're not taking opportunistic advantages of their clients, which is great. We are saving not necessarily loan forgiveness, but it's a little bit more of a, just a normal general business compassion, if you will. Let's go and go to the next slide. This is an interesting area, and if for most of the folks on this call, I think you're probably in that area of essential businesses, and you're able to keep things moving along. So really, the impact is depending upon which sector you're actually affected by, that might impact you. But as far as business as usual, it's not as usual, but at least you're able to conduct business and move forward and try to make ends work. Where differences have occurred is trying to pivot your business in order to respond to another business need, or at least try to go after different customers that might be in a more unaffected sector. That's what we've really seen as it relates to folks that are essential. Whenever you look at selling or buying a business today, and it's not a funny thing, but if you look at the amount of money out there that is able to be borrowed or even invested in businesses, it's huge. There's a lot of people that want to spend money, they want to invest, but the reality is the uncertainty is also equally as huge. So for essential businesses, there has been a highly sought after movement for private equity, institutional investors to invest in these businesses because they've been able to weather the storm. They'll be able to come out looking healthier than ever. And so what we've seen is where, for example, I'm just going to throw out that multiple, where multiples for a good business might have been 6, multiples for a good business today might be in the teens. So I think 11, 12, 13. So good businesses are going for a higher multiple. They are harder to find, and they are mostly in the essential area. The deals that used to be good in an area and fetch a good multiple, there's too much uncertainty because everyone's relying on forward-looking projections. So that's really been the conundrum in this area. So if you do see a exit in your particular business in the next couple of years, it actually might be worthwhile to look at that today and to see if you can actually fetch a better exit price on taking advantage of the multiples that are being paid by institutional investors. But to go through some of the facts on here, we've got a lot of businesses that are aging out, have succession planning issues, and need to have some structure changes, whether that's going to be in a family business ownership, a family business hierarchy where you're passing down those responsibilities to others in the family, or monetizing the business through a transaction. But there's a lot of movement. And then if you look at professionals and professional services, there's a lot of availability of talent out there that's affecting the professional sectors. So we're going to see a lot of churn, if you will, of individuals, businesses, and et cetera, I think over the next 3 to 5 years. So where we see no transactions or very relatively little transactions happening right here at the moment, because they're very calculated, and they're essentially being put together with other businesses. I think that's going to turn around, and we're going to see a large fluctuation of transactions happening that will change and consolidate, I think, many different sectors of businesses today. So is it time to sell? It's really, it depends on what your overall objectives are. You may be able to get a good multiple, but if you've got a horizon of 10 to 15 years, it may not be the right time to consider it. So just look at what you want to do with the business. I'm happy to visit on that if you'd like to. Let's go to the next slide. Personal financial ideas. One of the things I mentioned earlier, which is be on top of your personal finances, be able to provide a personal financial statement. We're not saying that they're requiring audited financial statements, so don't think that it's going to be anything too intrusive. You might be required to make some adjustments to your personal financial statements, or at least get them reviewed by an accountant. But for the most part, we haven't seen a lot of that. Even though there's been some questions coming from our clients, we haven't had to do a lot of procedures around it. So, don't think that that's going to, end up, costing some additional funds to get them. Just make sure that you're ready to have those discussions. So your projections in forecasts are even that much more important as you enter a lunch or whatever. Be able to talk about what the outlook looks like, what you've done to bridge pre-COVID to post-COVID, and what your impact is. And then from a tax standpoint, I know that actually we can go to the next slide because it covers taxes. It doesn't. Okay, I'll actually go back to the previous slide. Okay, so the key thing for right now, we're in December. Make sure you're meeting with your tax advisor. Make sure that you're understanding what can you do to take advantage in 2020 that may go away with the new legislative bodies that are going to be in place. So the Biden administration might have some changes that could change things considerably. Have those discussions. Make sure you do whatever you need to do this year for your particular situation, and don't wait on that. I pick up the phone today or relatively soon. And that next slide. The disruption solution. So the next couple of slides kind of walk through our way of looking at and understanding how our business is impacted, but how can you take certain steps to make sure that when everything goes back to normal, you're ready to change. You're ready to either go back to normal or change what normal means, and make sure that you're on top of it. And this kind of goes into make sure that you're able to talk about the changes, have your personal financial statements ready. You just want to be prepared for any type of cash crunch that may occur in the foreseeable future. So the next slide talks about, I think, since we've got a lot of folks on this call that are considered essential, the recovery period, you've probably already done a lot of this internally without even thinking about it. And the pieces to recovery, if you can go to the next one, we'll go talk about each one. Is revenue. How's revenue been impacted? But how have you replaced it? If you haven't been able to replace it through another sector or other types of jobs, or even services, what does that look like? And then if you do have debt on the books, or if you didn't before and you do today, how are you going to be able to service that debt and support that through your forecast? So where I think what we've seen is essential businesses have been just moving forward with revenue. They're able to make their debt covenants, but the ball's kind of being wavered a little bit when it comes to forecasting. So don't forget about that. If you haven't spent the time, because you haven't had the time to do so on the forecasting piece, pick that up and put some pen to paper on what the next couple of years look like. We don't have a crystal ball and we don't know when this is going to release, but you're still going to have a backlog that you can put some color around. You can figure out how you're going to fill in the spaces, because a lot of essential businesses are being affected on their backlog. In the next 6 to 12 months, there's a lot more uncertainty there. So contracts are starting to not renew, and some of the large construction projects around town that may have already been through an approval process, they will have already been completed, and new projects may not be as in different sectors. They may not be as many as they were before. So there is some trickle down that we're expecting to see over the next 6 to 12, even 18 months that could cause a further reductions in force depending on what type of services you're providing, or just a lack of backlog where you're going to have to find alternative ways to fill it and figure out how you're going to get that revenue in the door. And then that leads you right into the contingency plan, which if you skip forward to the next slide, which is stability. that contingency plan is really what you're going to need to make it through this next process, which is how are you going to continue doing what you're doing, servicing your debt, piecing everything together to where you've created a stable environment to retain your necessary employees to keep things going, but you're also able to identify what those new KPIs are with the new revenue sources that you brought into the business, and how are your key performance indicators being affected by the current environment. And if you're able to make it this far and talk and give some color to your bankers and folks that you're working with, I think you're way ahead of the game here. And quite frankly, you don't need an extensive contingency plan if you're able to talk about the impact to your performance drivers. So you may be able to put a little bit less structure around that if you're able to really work through all the roadblocks that the COVID environment's actually created for everyone. And then, the last step here is growth. Making sure that you're able to capitalize on not necessarily opportunistic things that come as we emerge from COVID, but being able to get back to norm, but while also hopefully taking advantage of some of the benefits that you've been able to extract from pivoting and how you're able to keep revenue coming in. So hopefully, if you've been able to make some changes in your BD and how you're getting new projects, you can continue to take advantage of those in the new environment once we get out of all this. That's kind of a scenario. We don't really know what the growth is going to look like until we see what, like one of the indicators that Lindsay was talking about earlier, which was, folks being able to make their mortgage payment, folks being able to to stay personally engaged in a normal life that we've had with the large unemployment rates. That can change with every month that we're further in this COVID environment. It is going to impact how we emerge from this ordeal. So that's a whole bunch of uncertainty and not necessarily bad news, but it's what we all have to deal with as we're working through this. Maybe we can open up to questions or thoughts or any personal matters that folks out there.
Yeah, and I'm sorry about that. I should have said something in the beginning, but if you have a question, you can either type it into the questions area and I can read it to them, or it's easier to say it verbally, raise your hand and I can unmute you and you can get your question that way. So give you guys a minute to get your questions in or your hands raised or whatever you're gonna do. All right, I'm not seeing any yet. Well, all right, I'm not seeing any. What I can do is if you think of something afterward or we get off and then, yeah, you're still typing right now, just shoot me over the question and I will get it over to Michael and Lindsay and we can get an answer for you. So I think that's it, correct?
That's our presentation. Thank you.
Awesome. Well, thank you both for taking the time to do this today. We really appreciate it. We've recorded this, so we will send out the link to the members, or if you were on this call and you're not a member, you'll get a link to it. So just in case you missed something or you want to go back and do it again. But thank you so much for being with us here today, and we look forward to maybe doing some webinars in the future.
Thank you so much, Brianna.